Coming up on Market to Market, President Obama explains why the worst is over, but he still needs more time. New research indicates organic foods aren't much healthier than their conventional cousins. And Hurricane Isaac brings much needed moisture to portions of the grain belt, but it's too little, too late for corn producers. Those stories and market analysis with Naomi Blohm next.
Funding for Market to Market is provided by DuPont Pioneer, working with growers to match the right product to the right acre. Science with service, delivering success. This is the Friday, September 7 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. Wall Street shrugged off disappointing news on the job front Friday as U.S. stocks settled near four-year highs. According to the Labor Department, U.S. employers added just 96,000 positions to their payrolls in August. That's down more than 30% from July. The national unemployment rate fell 0.2 of a point to 8.1%, but only because more people gave up looking for work. The weak jobs report increased expectations that the Federal Reserve will announce further steps next week to encourage lending and keep interest rates low. The Dow Jones Industrials rallied Friday and settled with a weekly gain of more than 300 points, while the S&P 500 followed suit with a similar move. Despite the running of the bulls on Wall Street, Friday's labor report has major implications for those hoping to reside in the White House. No president since FDR has won re-election with an unemployment above 7.2%. And as the incumbent accepted his party's nomination, President Obama touted the hope and change realized in his first term and pleaded with the American people to give him more time.
And the cause of change is not fully accomplished, but we are on our way.
Democrats ventured into battleground state North Carolina this week for the party's quadrennial nominating convention. Hoping to answer the Republican Party's rollout of Mitt Romney and Paul Ryan the week before, Democrats invoked a defensive stance.
If we want to earn the privilege to lead, my message is this: it's time for Democrats to grow a backbone and stand up for what we believe.
Emphasizing a diverse lineup of minority politicians, Democratic leaders spent 3 days mixing a theme of party unity and attacks on former Massachusetts Governor Mitt Romney.
Mitt Romney, quite simply, doesn't get it. A few months ago, he visited a university in Ohio and gave students there a little entrepreneurial advice. Start a business, he said. But how? Borrow money if you have to from your parents, he told them. Gee, why didn't I think of that?
But it was former President Bill Clinton that seized an entire evening of attention with an impassioned defense of Democratic economic principles.
President Obama and the Democrats didn't weaken Medicare, they strengthened Medicare. Now, when Congressman Ryan looked into that TV camera and attacked President Obama's Medicare savings as, quote, the biggest, coldest power play, I didn't know whether to laugh or cry. Because that $716 billion is exactly to the dollar the same amount of Medicare savings that he has in his own budget. You got to get one thing. It takes some brass to attack a guy for doing what you did.
Clinton, invoking a strong 1990s economy, told convention attendees and Americans that the Great Recession was far too disastrous for a one-term presidential fix.
President Obama started with a much weaker economy than I did. Listen to me now. No president, not me, not any of my predecessors, no one could have fully repaired all the damage that he found in just 4 years.
On the convention's final evening, President Barack Obama admitted his tenure has brought some legislative and economic disappointment, but urged Americans for some more time and a second term.
No party has a monopoly on wisdom. No democracy works without compromise. I want to get this done, and we can get it done. But when Governor Romney and his friends in Congress tell us we can somehow lower our deficits by spending trillions more on new tax breaks for the wealthy, well, what Bill Clinton call it? You do the arithmetic. You do the math. And that's because all they have to offer is the same prescriptions they've had for the last 30 years. Have a surplus? Try a tax cut. Deficit too high? Try another. Feel the cold coming on? Take 2 tax cuts, roll back some regulations, and call us in the morning. I'm asking you to rally around a set of goals for your country. Goals in manufacturing, energy, education, national security, and the deficit. Real, achievable plans that will lead to new jobs, more opportunity, and rebuild this economy on a stronger foundation. That's what we can do in the next 4 years, and that is why I am running for a second term as President of the United States.
Only 60 days and 3 presidential debates stand between now and Election Day. Demand for organic foods continues to outpace other segments of the U.S. grocery industry. Whole Foods Market, a natural and specialty foods giant whose stock is valued at $18 billion, reported second quarter profits of $117 million. Consumers pay hefty premiums for organic goods for a variety of reasons, including perceptions that natural foods offer superior nutritional benefits. But a study released this week by a leading research institution in the heart of Silicon Valley indicated organic foods may not be much healthier than their conventional cousins. A Stanford University study comparing organically produced food to its non-organic counterpart revealed no nutritional difference between the two. While the study indicated nutritionally an apple is an apple regardless of how it's grown, other findings support notions that organic produce is indeed healthier. According to Stanford researchers, 38% of the conventional produce tested contained detectable pesticide residues. Only 7% of the organic produce tested showed contamination from pesticides. A 2010 Nielsen study found 76% of consumers who purchased organically grown produce did it because they believed it was healthier, 53% believed that organic produce would help them avoid pesticides and other toxins, 51% believed it to be more nutritious, and 49% believed organic farming was better for the environment. The Stanford researchers drew their conclusions from previous studies comparing organic to conventionally produced foods. The analysis of 237 studies took researchers 4 years to complete and was done without outside funding to avoid compromising the findings. The Organic Trade Association reports despite costing significantly more, sales of organically grown foods increased from $1 billion in 1990 to over $26 billion in 2010. And according to the USDA, the retail value of the organic industry grew almost 9.5% in 2011 to $31.4 billion. Organic foods continue to gain market share in the food industry, climbing to 4.2% of U.S. retail food sales in 2010. Heavy rain from Hurricane Isaac could help portions of the drought-stricken Mississippi River, though experts say it wasn't enough to provide long-term relief for the vital waterway. In a good year, barges ship up to 500 million tons of goods up and down the river, including 60% of America's grain. But this year, the lowest water levels since 1988 are causing barges to lighten their loads. Isaac dumped 10 to 15 inches of rain on portions of Louisiana and Mississippi, but the deluge isn't expected to help the entire river because it's fed by the third largest watershed in the world, and much of it lies in the Midwest. Hurricane Isaac did offer a brief reprieve for portions of the grain belt, but in the heart of corn country, it was too little, too late. Remnants of Hurricane Isaac benefited producers in several states. Heavy rains fell last weekend in parts of the grain belt, which are still suffering under the nation's worst drought in half a century. The much-needed moisture reduced the number of acres in the worst condition, but other portions of the Midwest were not as fortunate. The U.S. Drought Monitor revealed dramatic improvements in portions of Missouri, Illinois, and Indiana, And the weekly snapshot shows the section of the continental U.S. in the worst two categories of drought, extreme and exceptional, dipped slightly to 21.45%, down 2 percentage points from last week. Iowa, the nation's top corn-producing state, missed out on virtually all of Isaac's blessing. Portions of that state's northwest corner slipped into exceptional drought. As harvest gets underway, 52% of America's corn is rated in poor to very poor condition. Nationally, USDA estimates 10% of the crop is already in the bin, well ahead of the 5-year pace. Midwest soybeans benefited slightly from weekend rains. According to the USDA, 37% of the bean crop is in poor to very poor condition, while nearly 30% of the crop is rated good to excellent.
Next, the market-to-market report.
Grain markets were mixed this week as the trade considered European Central Bank efforts to shore up the 17-nation euro and prospects for the Federal Reserve to jumpstart the U.S. economy. For the week, December wheat gained 15 cents, while the nearby corn contract moved fractionally lower. Much-needed rains dampened soybean prices as the November contract settled Friday with a weekly loss of 20 cents, while nearby meal prices moved $9 lower. In the softs, cotton gave back most of last week's gain with a loss of $1.54 per hundredweight. In the dairy market, October Class 3 milk futures lost 27 cents, while the deferred contract moved 35 cents lower. Over in livestock, October cattle gained 45 cents, nearby feeders were off 52 cents, and the October lean hog contract lost $2.82. In the financials, the euro gained more than 200 basis points against the dollar. Crude oil lost a nickel per barrel, COMEX gold advanced more than $50 per ounce, and the Goldman Sachs Commodity Index lost less than 1 point to close at 676.05. Here now to lend us her insight on these and other trends is one of our regular market analysts, Naomi Blohm. Naomi, welcome back.
Hi, Mike. Good to be here.
Glad you're here. How are you doing?
Really well, thank you.
All right. Well, it's been a big market in the broader scheme of things in Europe and in America with the jobs report today. What do you see happening in the equities markets here in America?
Right now in America, we're going to see the traders really focus on the Feds and if QE3 is going to be implemented or not. With the unemployment number today being lowered, of course, it looks like it's nice on paper, but since people are giving up looking for jobs, it's really a telling sign of the economy. So many people now are thinking that QE3 will be implemented sooner than later, and much of the weight was really centered on regarding Europe and what they would be doing with their marketplace as well. And so right now we'll probably see the U.S. economy just stay stagnant, not necessarily grow. A lot of people are waiting to see what the elections bring for results, and also wondering what the end of the year holds if the market just falls off the fiscal cliff just because of the taxes potentially starting to rise then. So we'll probably see growth hopefully just stay at around 2%. It definitely won't have reason to go higher than 2%. And of course, how that correlates with unemployment is that as long as the growth is under 2%, we're not going to see that employment number go under 8%. So that's what the current U.S. government's going on right now. And in Europe, what they did this week, the European Central Bank actually was able to say, we're going to go in and we are going to buy some short-term bonds for any country in the Union that needs help. And so that's just nice for buying time for Spain and Italy to try to help them get out of their debt situation. And for the whole market in general, I think it's going to buy time until year end. So we're at a standstill, and hopefully the just normal supply-demand fundamentals of the marketplace can come in, and we'll see what we can do.
So we're pretty much going to be just treading water.
Absolutely.
Until year end. Now, is there any black swan event out there that could maybe is on traders' radar to cause us to move one way or the other?
That's a great question. At this time, I don't know what I could think it would be. I think now most people are just focusing on the elections, and that's going to be the biggest potential, and if QE3 will be initiated sooner than later. I know the Feds meet next week, so we'll get some new commentary on that.
All right, so sit and wait till next Thursday, Friday when that comes out. Moving into commodities, what do you see going on in the wheat market? How do the fundamentals look there?
Fundamentals for wheat right now still is that it's a follower of corn and soybeans. If you look at a chart right now, wheat has just been walking on the sideways plank between 875 as support and 925 as resistance on the December chart. It's likely to continue to do that. The biggest thing in wheat right now still is with Russia. We've been talking about them for weeks. Will they or won't they stop the export? And the biggest thing is that with Russia, you can't count on what they're going to say. You just have to watch what they're going to do. The difference right now is that the USDA pegs Russian production at 43 million metric tons. And actually, most of the trade industry in Russia this week has come out and said, no, it's probably more like 38 to 40 million metric tons. And in 2010, when they actually did implement the export restrictions, they had their production at 41.5 million metric tons. So we are below that. The other factor in this is that their ending stocks in 2010 were at 15 million metric tons, and right now they're at 10 million metric tons. So it's a very tight situation. I think they're playing Russian roulette with themselves, and they actually need to be on the up and up because their membership with the World Trade Organization is on the line. So they got to play it cool and do the right thing, and that's what we're going to be needing to watch in the market. Until then, we'll likely see the market continue sideways, possibly until the USDA report next week.
All right, and is there a timeline for Russia making any sort of announcement?
Not that I know of, but I do know that there's going to be a G20 conference in Russia in October. And they're going to be talking also about the food in the Black Sea region and how the whole crop in general is down. So I would say between now and the middle of October, when they're supposed to be getting together, is our timeline.
All right, and so what are you telling producers with all this in mind?
Be ready for anything.
Okay.
Absolutely. If corn and beans can continue higher, the wheat will follow. Technically, if based on this chart, if the market continues to go sideways, then all of a sudden just falls on technical pressure or something like that, we could see a 50-cent wipeout pretty darn quick.
All right. Well, let's move over to corn a little bit. How are things looking there where we've been stagnant, pretty stable in corn as well? Similar concerns?
Absolutely. The corn market right now still is going sideways. It's been rather a boring market to watch. Stuck with 775 as support and 825 as resistance for now, and it just keeps flirting with the $8 mark. The biggest thing for corn right now to watch is the USDA report next week. And we all feel that they'll likely lower that production number a little bit. They'll lower the yields. The industry right now is around the 120 bushel number, and I think that's legitimate. The biggest thing to watch on Wednesday's report will be if they tweak harvested acres or not. We actually have some FSA certified acres that have come through now, and normally the USDA doesn't touch it until the October report, but some people think they might do it in the September report. And if they do, this will be new market information that has not been factored in yet, because harvested acres, of course, is dependent on how many acres have been cut for silage. Huge this year because of the drought. So we're going to see actually the harvested acre number as a wider difference than what it would normally be. And some feel that we could see almost 1 million less acres on that, which would be new bullish information in the market. And that could be what finally gets it out of this trough that it's been in and push it higher. Until then, we're stuck. We're waiting till Wednesday.
All right. So for producers, advice, wait till Wednesday, see what happens, or should they be taking steps to?
Well, what I've been recommending and encouraging is that if people have any old crop yet, maybe go ahead and move it. If you want to re-own it, there's different ways based on your risk style that you can go ahead and do that with. But you just have to also be ready for anything that could happen in case nothing happens on Wednesday. If it's a quiet, neutral report, sometimes path of least resistance is down, and then they could use the scapegoat of harvest pressure, and that's what made the market drop. But if we did see the market drop, it'll be a nice buying opportunity because corn would be on sale.
All right, and so looking long term, what's your forecast for corn as we move through this winter?
Well, I would say likely we'll see corn in the big picture ultimately have really solid support at $7. If South America gets off to a poor growing season, then that would be a reason for the market to ever try to push up towards that $9 level. At this juncture of time, I'm not quite willing to go beyond those boundaries because there's just too much outside perfect storm scenarios that would have to take place.
Right. Are you talking to producers about selling any of next year's crop, taking advantage of these prices?
This conversation is starting to come up, and we're starting to work with some different scenario plans that would be a way that we can implement it. So such as if the December 13 futures ever got up near $7, that's a good time to pull the trigger and make some cash sales. Or on the flip side, if the market ever went a little bit lower, know where your pull the trigger point is going to be on that side too. We're starting to look at different option strategies to cover for the downside. Haven't really fully implemented anything yet, but we are definitely thinking about it.
Okay, so the time is now to get your thoughts kind of rolling on that. Similar situation in soybeans. Are you seeing kind of the same advice going forward there?
The soybean market still has some long-term friendly indications. It is the friendliest fundamentally of the three grain markets, in my opinion, just because the ending stocks are so tight here in the U.S. and globally. What the market is watching now is South America. They'll be starting to plant next month. And so far, they're going to be off to a good start. The Nino pattern is weakening, and so what that means is that they're going to have normal rains. It could be everything is good to go, and I think the market is really watching that, and it's aware of it. South America right now, Brazil is expected to be producing near 81 million metric tons of crop this next year. That's up from 65 million metric tons last year. Argentina is expected to produce 55 million metric tons. That's up from 41 last year. So what that'll do is alleviate what happened here in the United States. It doesn't mean ending stocks are going to grow. It means it buys us more time to see how the American crop can fare from there. So in the meantime, on the soybeans, November beans, most likely a range where $17.25 is support, $17.75 is resistance. Bigger range is $17 to $18. We'll hold there for probably a couple weeks and see what happens in South America.
All right, would you be making sales in here?
Cash sales, yes. Be willing to re-own with some option strategies, and I mean, it's just good value. It's $18, and the only way it's going to go higher is if something goes wrong in South America.
Okay. All right. Let's talk cotton a little bit. They've had a down week a little bit. But what do you see going forward in the cotton market?
Poor cotton. It's one of those markets where the supply right now is so big, and the ending stocks globally are so large that it's not a happy tale for the cotton prices, and it's likely to stay that way for quite some time. India actually is on pace to have a record crop. They actually have had decent weather because the monsoons have not been horrible this year, so they're going to be producing a lot. With the economy not good, people are not buying lots of clothing, and that's really affecting everything in China and their factories there. So likely we'll see cotton actually stay with 70 as support in the big picture and 77 as some resistance for now, and I think we'll see that continue. Also, what I'm thinking for next spring is that we're going to see a lot of the cotton producers in the southern states maybe switch to sorghum. That's kind of the up-and-coming crop, I think. There's a lot of potential for that. And, of course, maybe a little bit more of a switch to corn and beans just because there's not really a big advantage in cotton right now.
All right. Let's move to livestock a little bit and dairy. What do you see in the dairy industry, short-term and long-term?
Right now in the dairy industry, things are looking really well for prices. We will likely see the milk market stay with prices with $19 in the big picture as tremendous support. But right now we've been hovering near $20, and that's likely going to continue to happen. Demand for milk is strong right now. Of course, production is just hanging tight, and we've also seen an abundance of slaughter with the animals happening, and that's going to affect next year. And already right now the USDA is saying that production is going to be down 1.3% for milk for next year. And 1.3% might not sound a lot, but for milk it really is a big deal. And so milk prices are going to stay firm. We think that prices ultimately could maybe go up to $22, which would be a test of the highs from 2008. And the big picture still looks friendly for that market for now.
All right. Well, let's talk fat cattle. Where do you see that market going? Those guys are facing high feed costs. What do you see happening in fat cattle?
Yeah, right now with the marketplace, cattle in general, as we know, the bigger picture supply is limited, and that's not expected to change. When looking at feeder cattle, that market is facing limited supply. It's going to continue to be that way. And it's more a matter of guts from the producer. If you're willing to take on the high feed costs and not knowing for sure where the market demand is going to go. We feel that most likely the feeder cattle market is going to find its bottom in the next 2 months or so and then ultimately shoot higher just because of the demand picking up again long term. With live cattle prices right now on the October futures, there's some resistance at 126. And most likely that'll just keep us trapped for now because demand is firm, but it's not amazing. And the restaurant index is showing that consumers are not eating out. It's at the lowest level it's been at in a year, and that kind of makes sense because it's back to school time and people have to spend their money other places. So most likely for the live cattle prices and the feeder cattle prices, just a sideways trend until we get into Christmas holiday time demand will pick up again.
You mentioned just briefly you expect feeder cattle to hit their trough here in the next 2 months. Are you anticipating any specific price point roughly that they'll hit on the low end there?
Great question. At this time, I don't have anything specific on it, but I would just say kind of keep an eye on it, and it has to correlate, of course, with the grain prices.
All right. Let's talk hogs a little bit. The hog market also facing tough times. What do you see going forward for hog producers?
They're going to continue to have a little bit of a tough time for maybe another month or so, just because there's such a glut of supply coming into the market right now. On Tuesday, slaughter was at 435,000 head, which was the largest it has ever been since 2009. And that's just, of course, as we all know, that with the high feed costs, it's just not making sense with the math. The average hog price right now is 70 cents a pound. Lowest it's been since 2010, almost 2 years ago. The cash market is down, and everything like that is going to just continue to weigh on sentiment. Now, the silver lining in this is that the sow market, and as far as slaughter goes there, they're not increasing sow slaughter. So that means that the producer is saying, we're hoping that this feed issue is a one-year deal. They don't want to reduce their reproduction, and so they're optimistic yet for the longer term. So we don't see them rebuilding herds at any time, but they're not giving up, and it's just, can they ride out this storm or not? So probably see that hog market still stay a little bit lower in the 70, 75 area for a little while longer yet. But because supply is going to be dwindling, it's going to set up this story for a friendlier market down the road, especially with our export markets still being red hot, picking up steam yet even more. It's going to just create that demand base further yet.
All right. Naomi Blohm, thank you so much for being here. That wraps up this edition of Market to Market. But if you'd like more information from Naomi on where these lofty markets just may be headed, visit the Market Plus page at our website. And speaking of the internet, visit Market to Market online this Wednesday at 5 p.m. Central Time, when Farm Foundation and the National Association of State Departments of Agriculture present the Presidential Forum on Agriculture. I'll moderate a discussion on rural issues with Nebraska Senator and former USDA Secretary Mike Johans, representing Governor Romney, and former Lieutenant Governor and Agriculture Secretary Patty Judge, representing President Obama. We invite you to post your questions on Twitter using the hashtag AgForum and join us online Wednesday afternoon at 5. Until then, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Funding for Market to Market is provided by DuPont Pioneer, working with growers to match the right product to the right acre. Science with service, delivering success.